What do stocks as diverse as Papa John's, Whole Foods, and Colgate have in common? All have stock splits in 2013. Joining us in this morning's U.S. Bank Economic 360, Mike Denneman, Vice President and Senior Portfolio Manager for U.S. Bank. He's going to give us some insight on these stock splits. Mike, good to have you back with us.
Good morning, Brian.
So, we have had these high-profile stock splits in addition to the ones we just mentioned, MasterCard also this year. First of all, what is a stock split and what is it telling us about the market?
Sure. So a stock split is when a company decides to adjust the number of shares outstanding and then subsequently the price of those shares. So the board will decide on a numerical factor, most often 2 for 1, and then apply that to the shares outstanding. So if you're an investor, you'll have twice as many shares, but at half the price.
So if you have shares at 200 and they split, you have 2 shares at 100.
Correct.
That's probably oversimplified. What does that tell us about the market, though? What's going on with these?
Well, naturally, if you're going to split your price, you're going to have a high price to begin with.
That's true.
So we've seen the number of splits occurring actually down in recent years, probably due to the turmoil in the market. But now that we're through 2013, we've had some record levels in the market. We're probably seeing a lot of companies thinking about the fact they're sitting at record high prices. That might be a good catalyst to see more stock splits.
What advantage is it for a corporation to split their stock, and why wouldn't they? I look at Apple, it's been above $500 a share. Why wouldn't they split?
Sure. So, well, if you think about what advantage to the investor there might be, it's hard to come up with a tangible effect there. Whether you have 5 shares worth $10 a piece or 10 shares worth $5 a piece, to the investor, the net is the same.
Yeah, it seems like a draw.
So for the company, the thought process is that perhaps more reasonably priced stocks would be a bigger draw for the average investor. So if you have a stock trading at 100, investors maybe shy away. If it's trading at 50, that might be more appealing. So whether that's true or not, that's hard to say. It seems psychological in nature. It is psychological.
But it seems to make sense.
It seems to make sense. And so while stock splits 10, 20 years ago very common, these days we see, as you mentioned, a lot of stocks that are trading in triple digits, and that's relatively rare. Not to say that splits aren't in the works, but for now they seem content to have those high share prices.
Of course, investors want to make money. That's why we invest. Is there any opportunity to make money due to these stock splits? Is there any way to play that?
That would be nice.
Yeah.
Of course, there have been numerous studies that have looked into stock splits and to see if there's additional returns you could gain by investing in stocks that are about to split or have just recently split. And while the answers are inconclusive, they seem to suggest that there's not a whole lot of additional return that can be gained by investing in these stocks simply for the split. Now remember, these are stocks that have high share prices anyway, so any additional gain following the split is likely attributable to that previous momentum rather than the split itself. So it's not a bad thing, it's not a good thing, it seems more psychological. It certainly keeps a company's name in the headlines, and that's always a good thing. So
we've learned a great deal this morning. I know I have. I've heard about these stock splits and now I have a better understanding. Thank you, Mike.
Thank you.
We appreciate you and U.S. Bank.